Rising interest rates have put bonds back on the table for investors, but is the party over once rates start to fall? Not necessarily. We're going to hear about a new type of fund using covered calls to boost the income from bond ETFs and what you need to know before making them part of your portfolio. That's next on Inside Investing. Hello, everyone, and welcome to the show. I'm your host, Caitlin Cormier. Joining us is Elliot Johnson, Chief Investment Officer at Evolve ETFs. Elliot, welcome to the show, and thanks for being here with us.
Thanks, Caitlin. Great to be with you.
Can you tell us a little bit about the work that you do at Evolve ETFs?
Yeah, sure. So I am one of the principals at Evolve ETFs. I'm the Chief Investment Officer and the Chief Operating Officer. And my group oversees the investment management, trading, and compliance functions at the firm. And so I'm heavily involved in product design, new product development, as well as talking to our clients and our customers to try to figure out what products we should be trying to put into the marketplace to meet investor needs.
Okay, very interesting. So you're kind of right in the weeds with the company. So that's we're getting a great perspective on this product. And we're seeing a lot more covered call ETFs enter the market in recent years. So what do you think is driving that trend?
I think it's the number of things. We've seen a lot of people go to covered call funds as a way to increase yield on investments they are planning to make anyway, but are looking to hold maybe through the full cycle, or places where they're looking for yield in times when interest rates are low. And so the covered call ETF category has actually been growing strongly in Canada for about the past 5 or 6 years. And they say, Canadian investors love yield. Canadian investors are relatively conservative investors. And so to the extent that covered call funds are a way to sell volatility and turn it into yield through the distributions on the fund, this sort of aligns with the appetite of the market. And I do believe that Canada is unique in the appetite for covered call ETFs if you compare us to the US and other places where they really started to copy what we've been innovating up here. But only really in the past year or so, they've started to try to catch up to us. So it's really a category that has been really a growing category within ETFs. And at this point in time in the market, you can find covered call funds on a whole variety of different underlying strategies. So there's probably something for whatever it is you're looking for as an investor.
Very interesting. It's nice to know that Canada's on the leading edge with something like that. We don't often get to claim a lot of things ourselves, so it's nice to know that we're on the head of the curve with this particular type of fund. All right, before we get into our conversation, just a quick note to our viewers. Subscribe to our YouTube channel, TD Direct Investing, so you don't miss an episode of Inside Investing. Make sure you let us know in the comments what you think about today's episode and what else you'd like us to cover on the show. With that said, let's get into it. First off, bonds were an unloved asset for many years with interest rates at historic lows, but they're back in the mix now for many investors. Why have they become so relevant again?
It really comes down to the interest rate cycle. And so we, in the past year and a half, have seen a historic rise in interest rates from a very, very low level, as you say, which meant that bonds weren't really paying a huge yield, to where the overnight rate is today of 5% in Canada and slightly higher than that in the US. You have investors who now, first of all, can earn a reasonable interest rate on bonds, even if they're buying government bonds, which are the safest bonds in the marketplace. But in addition to that, we also have, I think, a lot of people forecasting rates coming down next year. And so the way the bond market works is the central bank is raising interest rates. Oftentimes it means the bonds will lower in price because of how bond math works. But when central banks cut interest rates, bonds can actually do well in terms of capital appreciation. And so what we've found is a lot of investors are saying, now might be the time to take some duration risk in their portfolio, add back some bond exposure on the long end of the curve, and look to maybe take advantage of lower rates coming in 2024 or 2025, which is where the market is forecasting the rate cycle to be.
And when you talk about duration risk, you essentially just mean the idea that, if it's a higher duration, then it has a larger impact when interest rates change, right?
Yeah, that's exactly it. So in a nutshell, when you look at duration, in terms of simple math, it's the number of years until the bond expires, although it's slightly less than that because it's the weighted stream of payments. So for example, the US 20-year bond is about 16.2 years of duration. And the rough math is that for every 1% move in interest rates, the price of that bond would, all other things being equal, move about 16%. Now, it's not perfectly linear. It depends on supply and demand, a variety of other metrics in the market. But nonetheless, if you have a 16-year bond and interest rates are going down next year or the year after, you could potentially earn more on your investment than just the yield on the bond itself. You'll always get that yield until the bond is paid off, but you will also potentially earn a pickup because a lot of those bonds are trading at under par right now because of what happened to interest rates last year. And so a lot of investors are looking at duration, they look at the rate cycle, and they try to balance out where they want to be in the bond market based on their expectations of those two factors.
Okay, and so income, kind of as you mentioned, is one of the main reasons why investors could hold bonds. And with that in mind, there are new ETFs on the market that use covered call options to help boost the income provided by bond funds. Before we get into how they work specifically, can you explain how covered call options work for the audience, just in case anyone isn't familiar with what they are?
The way a covered call works, and the reason it's given the name a covered call, is it's a call option that is sold against a position that you have already in your portfolio. So let's take an example of if you owned shares of Apple stock. Let's say you owned 1,000 shares of Apple stock. You could sell a call option against that Apple stock. And if you sold, say, one call option, it would represent 100 shares. And so your call is covered. And what that really means, when you sell an option, what you're really doing is you're selling the opportunity for the person who buys that option to buy those shares of Apple stock from you at the strike price of the option. And so what it means to be covered is if that option expires what's called in the money, meaning it makes sense for the person who bought it to exercise that option and buy those shares because that strike price is lower than where the shares are trading in the market, they will call those shares from you. They will say, okay, thank you. I have an option to buy Apple from you, a call option I bought, maybe was at $80. Apple shares are at $100. I'm going to call that. I'm going to buy those shares from you at 80, and then maybe I'll sell them in the market for 100. I'll pocket the difference. That's what the buyer of the option is hoping to achieve. The seller of the option, if they're covered, has those shares available to deliver to the buyer. So what the seller is really doing is the seller is really hoping that the shares of Apple don't rise above that strike price during the time that that option is open. And when it expires, they hope that perhaps Apple shares are at $75 if they've sold at a strike of 80. Because if that happens, the seller of the option gets to keep the money they were paid for the option, which is called the premium of the option. And so really a covered call seller is somebody who's trying to earn that premium without losing the upside of the shares rising up through the strike. And it's a very popular strategy to use when you have long-term conviction in an underlying asset class and you want to go out and essentially you're selling opportunity to people that only sometimes will they actually take advantage of based on wherever the shares are, each third Friday of the month when the options expire. And so that's really kind of in a nutshell what you do. And it's a strategy that favors you being pretty active in terms of, picking those strike levels, picking the expiry dates, paying attention to what's happening in the underlying, whether it's a stock, which is most covered calls, or whether it's bonds in the case of what we're talking about today.
Okay. Okay, that's a great explanation. Kind of covered all the bases there to understand from both sides what everyone's looking for. So I think that covers it very well. So, like you mentioned, selling covered calls is typically done on individual stocks or equity ETFs, but these new ETFs we mentioned sell them against bonds. You just kind of alluded to that. So how does that work?
Yeah, so we're one of several issuers who have innovated in this ETF product this year and brought to the market covered calls on bonds. And we're all doing essentially the same thing. We're owning an ETF that owns the bonds, and that ETF itself has call options available on it. Everybody's using an ETF called TLT, which is the iShares US 20-year Treasury bond ETF in the US. It's a very efficient fund. It's a very, very large fund, and it has liquid options available to be written against it. And so what that does is it's the same as if you bought a big basket of US 20-year bonds. That's all the ETF is. It's been around for 20 years. It's a very large size, and the options market on it is very active. And so in that sense, the manager of these funds has the opportunity to go out and sell options against that ETF. And that's what we're doing. And so it allows us to own bonds and sell covered calls to sell that volatility and capture that premium I was talking about and increase the yield over what you would get just by investing in the US 20-year bond. So it's a unique product. It's another source of Canadian ETF innovation. And it's pretty exciting because I think it's at the right time right now where people are looking for yield in the bond market to find a way to innovate beyond just buying some bonds into your portfolio.
So why do these funds typically write covered calls against longer dated government bonds in particular?
So it's an interesting aspect of the bond market, but it also makes intuitive sense. The pricing of the long bond moves around a lot based on investor sentiment. And so this is all of the things we see in the headlines every day, right? So jobs reports, inflation reports, in the US, I mean, these are US government bonds, so the debt ceiling crisis that comes up in the political side of things in the news. All of that stuff combined with growth, combined with the fact that, the US is the strongest economy in the world, continues to be, probably still will be in 20 years. So there's a back and forth of opinions out there between people trying to guess what's going to happen. And so as a result of that, there's actually a reasonable amount of movement in the price of the 20-year bond. Over time, it actually stays in a fairly stable band, but in any given month, it can move quite a bit. This is a great thing if you're a covered call investor because you have volatility you can sell. You need to have a volatile asset, at least in a month-to-month perspective, to be able to sell some of that option to other people. But directionally, over the long period, it's relatively stable because the American government pays their debts. I mean, they will pay off the 20-year bond. They're not going to default on the 20-year bond. This is not, any of those kinds of circumstances in the world. But the information is absorbed by the market, and the opinions of the market cause the price to move around. And so there's now a way to gain income from that uncertainty by using a covered call fund that's holding a long bond as its underlying asset.
It's funny you say 20 years, and I'm trying to think back, like just over 20 years ago was Y2K. And like if you think about all the crazy stuff that was going on then, how would we ever be able to predict where we were going to be now? So I think it's even more impactful if we think backwards 20 years rather than forward. It definitely makes sense that there would be a lot of uncertainty about what could happen in rates and that sort of thing in that 20-year period. So I think that makes a lot of sense for sure. Okay, so what are some of the potential benefits and risks of holding a cover call writing bond ETF?
If you're buying a covered call fund, you absolutely have to want the underlying asset, whatever it is, bonds, stocks, a particular index. It doesn't matter. If you don't want that, don't buy the covered call version of that fund. You're not going to get something you like if you don't like that. That needs to be the first principle of investing in covered calls. So when I talk about risk as it relates to covered calls, the first thing I think it's important for everybody to understand is when you write a covered call, mathematically, you are reducing the volatility of the thing you're writing on. You're reducing the risk of the underlying. It has to be that way because you are selling volatility, because you're collecting that premium. Now, it goes both ways. You could lose upside return if the price goes shooting up and you've written a strike that means you get called away and you don't participate above that strike level. But also the premium you receive means that if the price goes down, at least you have that premium, which sort of offsets a drop. So then what's the risk? Well, I think there's a risk of losing upside capture on your investment if the manager of the strategy is writing too close to maybe the current price and the underlying moves higher quickly, or they don't write far enough out so that they don't capture enough premium. And what you're really looking for, and there's a bit of an art and a bit of a science to managing these funds, you're looking to get paid adequately for the possibility of losing some upside, but write close enough to today that you can crystallize that premium if you're correct and you don't get called away, and then write another call, and then write another call. Or if the price of the underlying drops all of a sudden, you can buy back that call you wrote crystallize most of the premium, and then go again and write another one. And a good manager in terms of covered calls can do that and is able to take advantage of that premium that's there in the market and minimize that risk that the shares just run straight up. In truth, when you look at covered call ETFs, there may be a month or two where the market does something unexpected and runs higher faster, and you underperform a non-covered call version of that strategy. But usually the manager is then going to react to that for the next month's worth of call writing, widen out where they put the strikes, and get back into kind of earning that premium.
And so individuals could do this themselves. They could write the calls themselves. So what are kind of the advantages and disadvantages of it being within a fund as far as cost goes?
So these products are more expensive than a non-covered call version, but usually not that much more expensive. And the amount of work you're getting for your money is really quite astonishing. You are totally right, Caitlin. You could write covered calls yourself. Every good options writing textbook out there will give you the recipe, but it's a ton of work. One of the things covered call managers often do is they put in a bid to cover to buy back that call in case the underlying drops all of a sudden. So every single morning you got to get in there and you got to put your orders into the market, and every single day you have to make sure you're monitoring your levels and do I have enough cover? Do I want to write more? And I think the biggest challenge for a lot of people with doing their own cover call writing is, do you really want to be investing every single day of the year? You know, and that's why a product company that does it for you and a product can take all that away, and you know you've got that strategy. That's part of the product. It's going to be part of the product no matter what you do. So I think that's right.
Okay, so we talked about these particular funds being high yield. What does that actually mean in terms of kind of percentage yields?
Yeah, so I think for the most part, these new funds are going out with double-digit yields, low double-digit yields. I don't think it's necessarily the best thing to do to just search for the biggest yield and necessarily pick that one, because you want to make sure that the calls are being written at a level that you're comfortable with. But in any event, the yields are strongly low double-digit yields, and so I think from an overall yield perspective in people's portfolios, they represent an attractive increase compared to what you can get for overnight money or a GIC. And really, that's the trade-off that I think you have to think about, because, you know, if you can do 2 times as well and get some extra duration into your portfolio by going to the long end of the bond market, this could maybe be an attractive thing to consider allocating to, in addition to where you may still have your cash position today.
Who would have thought 5 years ago we'd be saying you're getting 5% on cash, eh? What a change.
It's so true.
How would you say that the income yields on covered call bond ETFs generally compare to other types of high yield bond funds that are out on the market?
Yeah, so high yield bond funds typically are the result of lowering the credit quality that you are buying. Typically, you're buying bonds from a company. Typically, the company is in a little bit of financial difficulty, and you are taking on a lot of risk that that company doesn't pay back the bond. In the case of these covered call bond funds that have just entered the market in Canada, they're all buying through the ETFs US government treasuries. So this is the best credit in the world. So that's a very big distinction. You know, I think really when you look at high yield investing is a strategy where you need to be doing deep fundamental research on the companies that are issuing high yield debt. This is not that. This is just a way to increase the yield on a low risk credit. The other thing I would note also is high yield bonds tend to perform similarly to the stock market. And a lot of folks think about them in the way they think about equity investing. So if there's a bull market in equities, they go into high yield. It's another way to play a similar trade. US government treasuries have, they don't really have the same correlation to the equity market at all. So it's more diversifying in terms of the return stream, I think.
There's a lot of uncertainty about the economic and market environment right now. So, which sort of market conditions would a covered call bond ETF tend to perform better or worse?
The last 18 months have been historically difficult for bond investors due to the speed at which interest rates have been rising. I mean, we had more than a 12-month period where every Fed meeting and every Bank of Canada meeting resulted in a rising in the overnight rate. And that just meant that long duration bond assets got hit over and over and over again. So we've just lived through the worst of it, I would say, in terms of the bond market, certainly that I've seen in my career. So really, there are kind of two other market conditions. One is rates being relatively sideways, in which case a bond investment typically does quite well because you have a reasonably good certainty on what the value of the bond is going to be and what the interest rates are going to be, and it does what the textbooks say it's going to do for your portfolio: low volatility, constant yield, good income stream. The other market condition is dropping interest rates, which we have seen in the past. We saw in 2007-8, we saw it in March 2020. Rate cutting cycles are kind of come in two different flavors. March 2020, they instantly dropped rates to zero from, I think it was about 2.5%, 3%. But it was also an historic event, right? The other way in which rates dropped that we can look at in recent history is the global financial crisis. And so in 2007-8, rates also went pretty much down to zero, but they did so over about 9 months. And in retrospect, it feels like it happened overnight, but that was a much more slow moving thing where you saw rates drop, 50 basis points, wait a couple of months, 100 basis points, a couple of more months, and so on. And so it happened in almost like a staircase. During that time, yeah, bonds did well. Bonds were certainly the asset class of choice, but they didn't sort of have the same kind of rally effect. And so you saw like the U.S. long bond kind of still roughly hung out where it was. It appreciated a little bit, but certainly not sharply enough to cause you any problems if you're writing calls against it. And it was certainly a good place to be. And so those are kind of the rate cycle conditions for people to have in their minds. The other thing I'd put out there as well is it's generally the behavior of the market that if there is calamity, if there is a sudden shock, the people tend to flock to the US dollar, they tend to flock to US debt. It's just viewed as the safe place to go. And so if you're thinking about where to be in the bond market and you can be in US government debt, you're certainly putting yourself in the place that will benefit from a flight to safety, certainly in the short term, if there's a sudden calamity.
What are some of the factors for investors to consider that might distinguish one covered call bond ETF from another?
I think the big one to think about is uh, try to get a sense of where the manager is writing their calls. Are they writing out of the money or are they writing at the money? Some managers write at the money, which means they're giving up any upside in terms of collecting a bigger premium, which can lead to a higher yield, but it can also lead to lost upside, up capture, upside return. And so you want to make sure where they're writing their calls is giving you the experience that you want. So if you're going to go to longer duration because you want to pick up some of that capital gain if rates come down, it's usually better to be looking for a fund that is going to write a little bit out of the money so that you don't lose all the up capture and maybe you don't lose any of the up capture, rather than somebody who's writing at the money, which is where the strike is the same price when you write it as the price of the TLT or the bond that you're writing on. Most funds are writing anywhere from a third to 50% covered on their underlying. I think for these new bond funds, most of them are 50% covered. So first of all, that's good news, right? Because it means that even if the manager doesn't get the strike right in any given month, you're going to get 50% of the upside if there's a big move in the bond. Great, right? Then you're getting that. The more that's covered, usually that leads to a higher yield. But again, you're then have that higher risk of lost up capture. If you're writing covered calls against an asset class that's in a strong bull run, a lot of growth behind it, like technology or something, then you're going to want to write on less and write a strike further out because you're expecting those names to kind of run. That's what they do. Whereas if it's on something more stable like bonds, you can write a little bit more and you're not as worried about up capture and that kind of thing. So there's a variety of different things to keep in mind when it comes to that. But you want to make sure you've got enough uncovered, if you want to ask the question the other way, so that when the investment goes the way you're hoping, because again, first principle is, do I want this investment with or without covered calls, that you're going to enjoy a good portion of that run. And I think if you can get comfortable with that, then the covered call element is just an addition on top of that, just more benefit to you.
Just the gravy on top, right?
Yeah.
Management fees. How would you say management fees on these covered call bond ETFs generally compare to other actively managed bond funds on the market? So not necessarily other, obviously covered call, but actual bond funds on the market.
Yeah, I think that's the right comparison, by the way. I think too many people compare covered call funds against a passive index, and then they say, well, this doesn't make sense. But as I mentioned, there's a huge amount of work that goes into it. With actively managed bond funds, you're paying managers to do usually securities analysis on the issuer of the bond, a lot of fundamental research. And so these products are very competitive, and I think in a lot of cases, less than a typical actively managed bond fund. Certainly, I believe they compare favorably to actively managed high yield funds, which I think you accurately pointed out, Caitlin, is a good point of comparison because they're trying to also give a higher yield. But because they're in riskier credits, to run a great high yield fund, you need a great high yield manager. You need an investment team that is talking to those companies, trying to figure out which ones are really going to pay their dividends and pay back the bond. And options covered call overlays in Canada typically are priced very, very competitively for the value you get. And it's usually following a process. It's usually with a team that is using a variety of tested tools to make sure that they're doing a good job writing the calls over time.
Do you have like an approximate percentage as to what the MERs would usually be for this type of fund?
Yeah, it's going to be anywhere from, I think, 45 to 60 basis points of MER. And so it's going to depend on the manager where they price theirs. And so one of the things, back to the overall subject of fees, if you're looking at a fund that's got high single digit or low double digit yields net of the fee, you can get a sense for yourself whether or not you think the fee you're paying is going to be worth it based on the value you're receiving.
And for the breakdown on the fees and kind of understanding the whole fee structure, you mentioned company websites, so you'd be able to see the prospectus for that particular ETF within the company website, right?
Correct, yes.
Okay, perfect. Of course, how investments may be taxed is top of mind for many investors. So, how are the distributions from covered call bond ETFs generally treated?
Yeah, so you're going to have your distributions are going to come from two sources. You're going to come from the coupons that the bonds pay, which is dividend income, I guess, off the underlying ETF. It's income, it's bond income. That's taxed on income. And then you will have any appreciation in that underlying portfolio, that underlying ETF, those bonds themselves, that will be capital gain. And then the options premium, when you sell that covered call and capture that premium, that's also taxed on as capital gain. And the reason it's taxed as capital gain is because it's a hedge against the price movement of the underlying that you're holding. And so CRA says covered calls are to be taxed as capital gain. And so a lot of investors like these as yield products because it's quite tax effective to have your calls taxed as capital gain rather than taxed as income. And so it's also another thing that distinguishes these new products from high yield bond ETFs.
And when you say income, like you talked about dividend, but it would be taxed as interest income, like at 100%, or
Yeah,
would it be okay? And just a quick note to our audience, if you'd like to learn more about some of the options writing ETFs out there, check out our past webinar, 3 Ways Option Funds Aim to Generate Passive Income. It's available in the Learning Center on Webroker and on TD's YouTube page. Okay, Elliot, thanks for walking us through how these new covered call bond ETFs work and what they might offer for income focused investors. I'm sure you've piqued the curiosity of some of our viewers. And for those looking to do a little more research, let's hop into Webroker to find out how to screen for covered call bond ETFs. We are going to use our screener tool under research tools and screeners to find these bond covered call ETF strategies. So we're going to click on ETFs. It's going to take us to our screener page and we're going to click create custom screen. So the criteria we're going to use today is we're going to choose fund category and I'm going to use Canadian Global Fixed Income. I'm going to scroll through alphabetically to that. And I'm going to make sure I've deselected mutual funds because I do just want to see ETFs today. And then the other thing I'm going to choose is fund inception. Because these funds are so new to the market, we can actually choose funds that were created within the last 90 days or within the last year to filter it down to find these particular ETFs. So I'm going to go ahead and view my 18 matches. Now, once I get in here, what I'm looking for is an enhanced yield, maximizer, or premium yield to kind of indicate that it could be a covered call ETF. So here I'm seeing enhanced yield. So that looks like it could be covered call, yield maximizer, premium yield, uh, premium yield. And again, long term, because we were looking at these kind of 20 plus year US bonds, treasury bonds. Down here, I'm seeing one that does show that 20-year US Treasury bond. However, it doesn't say anything about premium yield or maximizer or enhancer. So it's probably just a bond ETF, not with that covered call portion. So once I've found a few of these different ETFs that I want to do a little bit more research on, I can either go ahead and add them to a watch list just by clicking on the name and clicking to a watch list to kind of keep track on them moving forward and be able to sort of track the progress of these funds. Or I can do a comparison. Now, I will say with comparison, there isn't really a lot of information yet about these particular funds because they have only been around for a short time. You can see the volume of trading, assets under management, information like that. You can also see how long they've been around for. But again, there isn't really any performance information or MERs or distribution yields. If you wanted to get more information on that, you should go to the company's website and be able to find out from the fund manager what the expectation for those sorts of things are, and you can find out additional information. So using the screen as a way to sort of find some of those names and then kind of help you on your way to do some additional research on these funds. All right, we're going to have to leave it there, Elliot. Any final thoughts that you'd like to share with our viewers?
Yeah, thanks for having me on, Caitlin. And I'd encourage everybody to, if you don't already know about Evolve, check out our website at evolveetfs.com. We have a ton of materials there on all 10 of our covered call ETFs, as well as all of our other investment strategies. So I would encourage people to go there. You can also sign up for our newsletter and reach out to us if you have any questions. We'd be delighted to hear from you, find out how maybe you're thinking about these products as well.
Thanks again for joining us. And for those in our audience, make sure to register for our upcoming live webinars and check out our library of on-demand content available in the Learning Center and on our YouTube page. See you all next time. Have more questions? Check out the links to the right and in the description below.